Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Excited to be back here in studio, season 3, episode 16. Here we are in the heat of summer, it couldn't be any hotter here in the Midwest right now.
It could not. You know, the Ohio Valley region, as they call it, heat index today is a poppin' 111 plus.
Yeah, it's popping about as high as interest rates are here this past week. So it's certainly something we'll be getting into today. But a lot of news here as we're sitting here in studios talking this Friday. We got to get to all the things that came out of Jackson Hole this morning from Fed Chair Jerome Powell and his co-workers at the Fed.
Yeah.
Jackson Hole originally, the reason why they all congregate there this time of the year every single summer is I forget the name of the Fed chairman at the time. I think this is going back to like the very beginning stages of when the Federal Reserve was actually created, like right around, the Great Depression time period. They gathered there just because the head of the Fed at that time, he was a huge fly fisherman.
Oh.
So he was like, hey, I'm going to go out here and fly fish. You guys all come out to me and I'll fish while we powwow about interest rates in the economy.
That is a flex.
So
I thought it was just because Yellen, she wanted a little space for the kegger she'd like to throw every now and then. But
I mean, maybe. I've never been. I was kind of joking around with the president of our company here, John Ashcroft, and said, hey, maybe next summer in August, we'll just pop into Jackson Hole. Because I do like to fly fish. It is a hobby of mine, passion, for sure, a lot of fun. But I would have loved to drop in on some of the things that these guys are talking about. And I'm going to talk about it today just to get some of the frustration off of my shoulders and into the ears and eyes of the viewers here today.
Frustration has been abound for the Shepherd Wealth Management team the last few days. So let's purge all that.
Yeah, I mean, performance for us as a whole, as a company, for individual clients has been fantastic. We're certainly beating the S&P by quite a bit. You can check out prior podcasts to get some insights into that, what we've been doing, how we go about doing it, why we're different than a lot of other institutions that you could work with as far as hiring them to manage your assets and get financial planning advice and so forth. Check all that out, shepherdwm.com. We have archived in there all of our newsletters. Going back to the beginning of this year, I had a completely different view on the market than what Consensus did and the news outlets and so forth. And we just basically take control of the two things that we can control here as investors. And one of the things that we control is our asset allocation. Just a fancy way of saying this is how much of an investor's money is in stocks, bonds, and cash. You can control all of that, and the best news about that is that explains 94% of the variability of performance of the account or the portfolio over any period of time that you want to look at. So that's great news. You can get control over the variability of performance by controlling that. And the other thing that we can control as investors is our temperament. And what is that? It's just kind of how you make decisions with your assets, your money, over stressful circumstances. And this is something that's very important. Buffett talked about this famously, that he would rather hire somebody at Berkshire Hathaway with a high degree of temperament as opposed to somebody with a whole bunch of fancy degrees next to their name.
Yeah.
And the reason for that is behavioral finance, which is a field of study in the industry of finance, of course, that basically explains how human beings make decisions under stressful circumstances. And what we learned from that study is humans, are hardwired with fear and greed. Going back to caveman days, we haven't changed all that much because of this hardwiring. And what we've learned from this study is we feel losses twice as much as we feel good about making money. And that's why human beings tend to have this fight or flight emotion. When you see these headline news that we'll be talking about today, can cause people to be fearful, right? And we're risk averse by nature. By our design. Therefore, we start to make emotional decisions with our money. And typically that's the recipe for not having long-term success. And that's what we want to be able to take control of here for our viewers, our listeners, our clients here at Shepherd Wealth Management. And that's what this program is all about, is because I know what's on the news. I have it on here every day. I consume it all throughout the days, weeks, months, probably more than anybody else that's watching and listening to this, because it is my job to understand all this. But what I do know for sure is the news does a terrible job of giving historical precedents. Like, these are the other instances in history where these similar events sort of happen. And this is what the market looked like for these industries, sectors, companies over the next 6, 9, 12 months. And that's what we really put into this program. We put into our newsletters, our Friday blogs that I'll be writing here today, this afternoon. We put all this stuff on our website, shepherdwm.com, because, again, I know what the news is saying, but there's no historical precedent attached with that, and we provide that.
Yeah.
And we also give our perspective on what we're doing for our clients relative to the information that we just put out there for everybody to take a look at. So I'm excited. A lot of stuff to talk about today. I don't have like three main things that I'm going to hit on because there's all this stuff came out here within the last hour, and it's a little bit of frustration on my part, but we're going to talk about it here today. So I hope everybody enjoys this. Grab your cup of coffee and enjoy it. So here we go. First thing I want to get into, though, is the good stuff. So NVIDIA.
Yeah.
NVIDIA definitely had another mic drop quarter. It's our largest individual position for customers here at Shepherd Wealth Management. It's obviously been the darling of Wall Street this year from a performance standpoint because the prior quarter, so Q1 results that they posted, I want to say in April or early May, they basically said, hey, we're going to do $4 billion more in Q2. So Q2 would be April, May, and June than analysts expected. And the stock shot up like 24% basically overnight. And it's been up over 200% performer year to date in the S&P. Now this quarter, which we got all of their quarterly results on Wednesday of this week, they doubled their revenue. This is $1 trillion chip making company. They doubled their revenue in 1 year to $13.5 billion.
That's incredible.
For that past quarter, right? They doubled the revenue. And the other cool part that this was, blowing out expectations from analysts. Analysts were expecting $8.3 billion coming from their data center. And data centers really is just all this AI demand. It's where a lot of it comes from. They posted 171% year-over-year growth in their data center. They posted over $10 billion. So they beat that number just by itself. That's one of the numbers, right? Because they have not only the chips, they make stuff for video games and all this other stuff.
Right.
They blew data centers out by over $2 billion just in that one space on of itself. That was 141% rise quarter over quarter, just from data center sales itself. So really what that's pointing to is the AI demand. This isn't hype. Like this is real stuff.
Oh, yeah.
That's showing up at the bottom line, not just for NVIDIA, but other companies as well.
Yeah, I mean, we've talked about this on the show before. AI has been around for a long time, and what we're dealing with isn't actually, when you think of AI and this sentient thing, it's not what's going on.
Yeah.
Video games especially have had large amounts of AI. You think about, algorithms and, back when you had iTunes, it was called Genius software. It could predict what you'd want to hear next just based on what you were clicking on. All those things are AI that we're kind of getting to now. So
yeah.
The AI explosion, has been coming, like
right.
you said, and it's only recently when it's been used to maybe change industries that relied more on human ingenuity and creativity. And really, the crux of this anti-AI argument is taking it down to can you replace that with just predictable algorithms?
Yeah, I mean,
but your point is, NVIDIA is. I didn't mean to derail it to get an AI, discussion here. But the fact is, we've been living with this amount of AI for a long time, and NVIDIA has totally positioned themselves to be the vanguard of providing that technology for the future.
Right. The way that I see it is, you had the internet happen, and then companies like Amazon coming out there that really changed things, and they started to figure out a way to put a product or service in front of a customer before they even knew that they might even want that thing.
Right.
Right.
The David Bowie effect.
Exactly. That was that big data era. Like when I was in college, grad school, that was what everybody wanted to talk about. Big data is the thing. Big data is the thing. Yeah, that data is great and helpful in the early stages of technology development. This AI thing has been around for a while, but now it's taking all that data and actually predicting things, right? Making a difference for corporate efficiency. So all the nuanced tasks, they can now be replaced by this new technology, this new software, whatever you want to call it. And that might replace some jobs, no doubt about it. But when we've had this labor shortage issue going on for years now and still dealing with it today, like if you want a job right now, you can go get one. That's the best part about, the world that we live in right now. And that's a big reason why I don't think that we actually went through a recession technically last year, even though it definitely felt like that. And I talked about that, a lot last year.
Yeah.
A lot of people called for a recession this year and didn't see that happening just due to the fact that we have this very tight labor market, unemployment being where it is around 3.5 to 3.6%, well below historical levels. And this AI revolution is just simply making things more efficient for companies who can't hire fast enough, right? And are not going to wait around for Congress to pass immigration laws. You're not allowed to clone anybody as far as we know. This technology actually solves a problem as far as, since you can't have somebody doing that task, now you can use this piece of technology to do that task for you without hiring somebody. And obviously that goes right to the bottom line of the company because there's no healthcare benefits, no 401k stuff, all that sort of stuff.
Yeah.
And that individual human that now got replaced by this technology is now freed up to other parts of the economy that we do actually need, help with, whether it be manufacturing or other parts of the S&P 500. So I actually think this is a great thing. And this has happened in the past as well. We wrote about it several times. And that's how the tech sector got to as big as what it is today. It's nearly 30% of the overall S&P from a weighting perspective. And for those that aren't familiar with the 11 sectors of the S&P, tech's the biggest. Second biggest is healthcare. Healthcare is about 15%. And that means tech not only is double the size of healthcare, but it dwarfs all the other sectors of the S&P. So that wasn't true back in the 30s. We didn't really have a tech sector hardly at all. We were a manufacturing and finance company. So how did we get to where we got from a technology sector standpoint? It's because tech is actually solving problems.
Yeah.
And this is a huge problem solver for us here in this country and around the world.
Yeah, and there's not a single issue that we're facing today that won't be solved by tech to some degree going forward. Yeah.
I personally think, based on what history has to say, and again, we wrote about this, so you can check it out on our website, I think tech could easily be close to 50% of the overall S&P 500 in the next 10 to no more than 15 years, based on this new technology and the productivity, I think, boom that we're likely to have. I mean, truly, this is not only solving a problem from a human standpoint, it's disinflationary.
Yeah.
Right? You could actually come into the future coming years here as this technology gets better and better, of where you have growth because of this efficiency and productivity, but also have disinflation because, again, you just need the chips and the data to run this AI system, right?
Yeah, I mean,
there's again no breaks. There's no holidays that system needs.
Oh yeah, no, in that regard, no.
All that stuff. So you actually could have a lot of growth due to this enhancement in productivity, and also have disinflation because you're not paying. You're hearing about wage gains being a sticky part of inflation or driving inflation. That's certainly something that Powell talked about today, which I don't agree with at all. I think there's a lot of data that points to the fact that that's not actually driving inflation in any sticky way, but this technology does solve for some of that as well.
Yeah, I agree. And I'm sitting on this side of the mic. The hope that I have for the future with AI is that not only, as you mentioned, it drives productivity and efficiency, but it frees up space in our American paradigm where maybe we don't have to have a 40-hour work week. If things are that efficient and that productive, people can have more free time to invest in either a passion or be with their family and friends. Maybe we don't have to have this kind of gig mentality that like you have to be working all the time, all day. Like, to me, that's not a healthy thing. We're not put on the planet to be doing that. So that's the future. I'm hoping that we use AI to free ourselves up a little bit, give ourselves more leisure time to just pursue living.
Yeah, I think the options are going to be there, right? And that's great. And it's huge for NVIDIA because, getting back to their earnings, I mean, they have the market to themselves in this specific space.
100% at this. Yeah. We talked about this before we got on the podcast. So,
we might as well talk about it now because this is what everybody seems to want to talk about. And I'd rather talk about this than what Jerome Powell had to say, even though I'm about to get to it. Because again, I got some,
well, it is nice to have something on the docket to talk about today that isn't what we've been talking about the last year and a half, and is not what we're going to be talking about the next 8 months of the election.
I mean, this is so cool. I mean, like, they really have the whole space. I mean, the numbers are showing it. They're going to blow future quarterly numbers out of the water, and people don't really know how to take it. Like, the question always is like, how can they sustain this runway? I mean, clearly they're not going to do 100+% in revenue, every quarter or every single year. As of right now, There are other players, Amazon, Microsoft, Apple, Google, you name them. They're creating their own chips. That's great. They have a large data set, all of those companies I just named. That's great. And their chips that they're making may actually be better than some of the NVIDIA chips that are out there for those specific companies. But in order to integrate all of that data along with this concept of open architectural AI,
Right.
you have to use NVIDIA's chips. I mean, you can't even use AMD stuff right now. AMD, Intel, they're probably 18 months at the earliest, 2 years at the earliest, to even have something that they can roll out to stand next to from a competition standpoint.
A corollary.
Right.
Yeah.
And the bitch of that is that's 2 years from now. So NVIDIA is not just going to be like, yeah, we got the market to ourselves. We're just going to sit back and relax.
Yeah.
They're going to innovate as well.
It's not a 2-year Mai Tai binge. You'll everybody catch up to them.
So the fact that NVIDIA is selling off after they mic dropped just yet another quarter, to me is more fear than anything else, right? They think that this is as good as it's going to get. It's kind of like, this is reminiscent to me when the only thing that I can compare this to in my lifetime, and I think it's actually the only true, really good comparison, is when Apple rolled out with the iPhone. Everybody was like, oh, the iPhone is going to kill all the, was it the iPod sales? And it did, but who cared? It was a way better product.
You just got an iPod you could talk to your friends through, you know?
Exactly.
I mean, I can remember getting the first iPhone that came out, and that was part of my decision making. Was like they had the iPad Touch that rolled out like slightly before the iPhone, and actually was given one as a gift with the receipt. And I was just like, no, man, I'm just gonna get a phone on top of this iPad Touch.
And the funny thing is, I don't know if you remember this at the time, but when they first rolled that out, I mean, you couldn't even copy and paste on the first iPhone.
Oh no! I mean, you couldn't even really attach things. You couldn't do a whole lot. Like you couldn't listen to music and talk on the phone at the same time. I mean, the tech was so, we would consider it archaic from where it is now, but at the time, oh my God, it was amazing.
I mean, that's the point though.
And it was the Wild West with all those third-party apps before the App Store got wrangled in by you know? I mean, it was nuts.
That's the point though. It's like that happened not that long ago.
No, like not even 20 years ago.
Exactly. Now, this technology is just starting to make a dent right now. Like it just got rolled out to like the world like last November, even though to your point, you know, other companies have been doing this internally in-house for years.
Yeah, it just hasn't been it's just been encased in other experiences we've been having with software. It's like you haven't been able to go to a website and just be like, let me use AI to do some simple task. It's just been encased in things like iTunes or video games, but it's the same stuff.
Yeah. And that's my point. It's like, if you were the guy or gal that said, oh man, you know, Apple's coming out with an iPhone, it's going to kill iPod sales, I'm out of this thing. I've made some money, you know, just like NVIDIA this year is up like 200% whatever it is. You know, I'm happy. This isn't going to last forever. There's other competitors going to step in eventually. Yeah. But to me, anybody that's selling these shares at the moment, unless, you know, you have something that you actually need to go pay for, like I get that.
Right.
That's what investing is all about. Taking profits, you know, occasionally. And there's nothing wrong with rebalancing if that's what people are doing. I'm not saying that people are just selling this because of fear reasons, but what I think is actually happening, and this is the question of the week, maybe the last 2 weeks that I've been getting, is why is the market falling? Earnings have been awesome. Like
Right.
over 80% of companies that have reported earnings, which is damn near everybody at this point in the game, they're beating earnings estimates. And they're beating them by, you know, a median of like 7%. Which is awesome. Those are above normal numbers. When everybody else said that in this year, earnings were going to be terrible. They haven't been. So what is the question of the last couple of weeks relative to why the market's not been performing well? Has everything to do with interest rates going up. And not because the Fed is necessarily said anything other than this morning, but leading up to this morning, interest rates across the curve were rising. So the short end, the 2-year was going up. Now it's over 5%. We haven't seen that since well earlier in this year, when everybody was calling for a recession and the Fed was, you know, hell bent on taking rates to, you know, maybe 6+% is what a lot of people were saying. We saw the 2-year spike up to around 5.1%, and the market fell off And that's when Silicon Valley Bank broke. Right? That's where we had 3 or 4 bank failures was right around that time. And now we're seeing interest rates come up back to about that level. 10 years up above 4.3%. I mean, this is where the levels were when Silicon Valley Bank collapsed.
Yeah.
And that's why I think the market's selling off, is because they anticipated Fed Chairman Jerome Powell coming out today and being hawkish in his tone. And he was, to some extent. Maybe some people might call it mildly hawkish. The point is he basically said, and he did say, that we will continue to be data dependent, but we're more than ready to increase interest rates if we don't see further, acceleration decline of inflation, which it has been recently. He did actually acknowledge that, saying, yeah, we've made some progress on inflation. But he also pointed to some things that he thought might keep inflation elevated, at least higher than what the Fed would like it to be. And that's what caused interest rates, again, to still stay elevated to where they're at right now. And that's the big reason, in my view, that we've seen the market sell off here recently. But the question is, in my mind, is why do you have to even go there? Of course, you could say this. Of course, if inflation, pops up again, we've seen 3 straight months of deceleration on inflation. CPI is now back to about 3%. It peaked last June at 9.1%. So we did actually acknowledge that. So some of the things that they're doing are working. But the fact of the matter is, he could have just simply said, hey, it's not only working, but we think it's going to continue to work because of the lag effects of monetary policy. We're going to get some more inflation and jobs data coming out here in the next couple of weeks. And then we're going to meet again, and we'll make a decision at that particular time. But really what he said, what I hear him say today, is that if inflation stays high, we're going to keep raising rates. If we continue to get the same sort of results that we've been getting, we're going to hold policy exactly where it is right now, meaning that we're not going to cut rates. We're going to hold them right here where we're at. And holding them right here where we're at is exactly what I think the Fed needs to do.
Yeah. Do you think he's trying to sabotage it with this hawkish tone? Like, what's the point of that rhetoric?
I mean, his whole point of the rhetoric, I think, is to keep the expectations, like that actually matters, the sentiment, right? All the soft stuff. So this isn't like technical stuff. This is soft stuff, like consumer sentiment on future inflation. He wants to keep that anchored extremely low.
Okay.
He's basically giving himself a two-way street here in all coming future meetings. I can raise rates because I didn't pigeonhole myself and saying, hey, we've got inflation pretty much under check here. So he didn't obviously say that. So he could, raise rates clearly if he wants to. Yeah. But he also acknowledged some of the progress that they've made on inflation. And if things keep kind of going the way that they're going, we don't need to really do much, at least not at the next meeting. And we'll go meeting by meeting to make those kind of decisions. That's what I heard today. The market heard some of that. You saw some interest rates actually fall while he was talking, and the market rose. You saw the NASDAQ more than 1% while that was happening. But as I'm sitting here talking right now, maybe close to an hour post his comments, the markets are basically flat. And interest rates really haven't moved all that much one way or another. So I think that the market's going to take this in stride going into next week. Where we have our first look, or our most recent look at the Fed's favorite inflation measure, PCE. And we're going to get that data next Thursday. As far as timing of that data, it looks like that's going to be coming out in the morning next Thursday, August 30th. Yes, at 8:30 a.m. So a week from today, I'll be anxiously awaiting that data point. The market looks like is expecting a number on core PCE to come in at 0.2%. I pointed to a whole bunch of data that would show us that we're probably going to see a number softer than that, meaning lower.
Oh, wow.
And that would be great.
Yeah,
right?
that would be.
I mean, the main drivers of a lot of the recent inflation that we've seen here is used car prices. Those have been falling off a cliff. There's actually been an article here in the Wall Street Journal that was posted just yesterday talking about the delinquencies in auto loans. Effectively, this is going back to the beginning of the year. So car prices, this is the title of the Wall Street Journal article on August 21st. Car prices might be unsustainable for buyers. Quote, the performance of loans issued in the first half of last year at the peak of the price surge has been especially poor. Let's see. defaults and missed payments on pools of auto loans made in the first half of last year to people with subpar credit are matching or outpacing those issued in 2008. So even though that's been showing as a positive number on inflation, positive meaning not good.
Right, sticky.
Exactly. This is suggesting that that's going to fall off a cliff. Used car prices should be coming down substantially relative to what this article is talking about.
Yeah.
And the other thing that people keep talking about as it relates to inflation, of course, is auto loan delinquencies, like we just kind of talked about that. But because of the auto prices going up, that also makes the insurance for autos go up, right? So 2 of the 3 things that were showing positive inflation were used car prices. Again, I just touched on some numbers here that would suggest that's going to fall off a cliff. And the other one being, because those used car prices have been elevated as of last year up until earlier parts of this year, that makes the insurance cost come up a little bit as well. Now, the third and final one is shelter, right? And that has the longest variable lag effect in the CPI numbers. But there is also a Wall Street Journal article written on the same day, August 21st. The title was Pay for New Hires is Shriveling. So among postings for more than 20,000 jobs on the ZipRecruiter site this year, the average pay for a majority of roles has declined from last year. So all those people switching jobs are not getting paid really at all difference in compensation like they were last year. They're getting substantial raises just by switching jobs. All that switching of jobs and higher pay, when you have more money in your pocket, you're more willing to go pay more for cars and homes and all this other stuff. Now that that's not the case, you really cannot point to, wages being a sticky part of inflation.
Right.
Inflation. You can't point to, based on this data, used car prices and the cost of auto insurance being a sticky issue anymore. The last thing would just simply be shelter. And again, it has the longest lag effect to it, but we just started to see signs of inflation showing deceleration. But hopefully we'll see a ton of deceleration coming up here in the next Friday's PCE, and the following week I think we get CPI as well. So hopefully that data starts to show up there. But I do believe the used car prices and the insurance associated with that will fall. Now, let's get to the Fed stuff here.
Yay.
So the first thing that I wanted my clients to know coming into today was some history. So I'm about to drop some knowledge here. So equity markets behavior post Jackson Hole since 2003. Our analysis suggests that there's about an 80% probability of a rally post Friday, meaning today. And here are the reasons. Since 2003, there were 7 instances of the S&P 500 down 2 weeks prior to Jackson Hole. So again, for the last 2 weeks, interest rates have been coming up, kind of anticipating hawkish comments by the Fed today.
Yeah.
Markets have come down from their highs earlier this year of a little over 4,600. So there's been 7 instances where we've been negative on the S&P 2 weeks leading up to a Jackson Hole meeting, going back to 2003. 6 of the 7 times equities rose in the week post Jackson Hole. So this would be next week. For all of you watching today, congratulations. You should be well prepared going into next week relative to what history has to say. Now, obviously, for all those compliance folks out there, past performance is no guarantee of future results, and investing could involve risk, including risk of loss. However, the one thing that Warren Buffett famously said about human beings is we know for sure, quote, that human beings do not learn from history. So I'm giving you all a history lesson here, just in case it happens to repeat itself.
So maybe we can use that.
Effectively, yes. But 6 of 7 instances where equities rose in the week post Jackson Hole. The range of gains was 0.5% to more than 5%. The only exception where the market actually fell post Jackson Hole was last year, right? And this is August. So last August, we were just peaking out on inflation, right? Inflation, like July of 2022, was at 9.1%.
Wow.
So, of course, a year ago at Jackson Hole, the Fed was extremely hawkish in his comments on, getting interest rates on the Fed funds high to combat inflation. So that was the only time since 2003 where we've had a negative post Jackson Hole week. So I'm anticipating markets are finding a bottom here this week, and we'll have a nice little rally coming into next week. And if history repeats itself, it should be somewhere in the range of 0.5% to maybe more than 5% before we get into September. But obviously next Friday's PCE number is going to be extra important because the Fed himself said that is the one inflation data point that they pay the most attention to. So next week's going to be another hell of a week. And unfortunately, we're still going to be talking about the Federal Reserve and what they're going to do with interest rates in our next podcast, roughly 2 weeks from today. So we're not getting away from them, is the thing.
I think my response is, yee howdy.
I know, but everybody gets to look forward to all the conversations that we'll have about presidential election cycles and what the market has to say about that coming up in future podcasts. Now, the other thing that I wanted to touch on here real quick, Ez, and keep me on track here, man, if we got any questions from viewers that may come up.
Alrighty.
Just touching on some of the notes regarding treasuries over the past week. So again, this is kind of the catch-all question leading up to Jackson Hole is why has the market been selling off? Is because interest rates have been going up. Actually, as I'm talking now, markets are recovering. Dow's up over 0.5%. Looks like oil prices are popping a little bit. And the NASDAQ is showing positive. So we're green across the board here. So this is how fast, the market will move relative to when Fed Chairman Powell actually talks. You're literally like dissecting every single word and meaning of it. So here we go on the interest rate data here. So the two-year Treasury yield touched 5.1%. I talked about that. It was up 8.4 basis points as of the last couple of days, but it's really been up nearly 50 basis points over the last several weeks, which is a tremendous amount of movement leading up to today, which is I think a good thing. I think rates are topping out now that we've gotten to Jackson Hole. And the Fed said what he said. Now I think we'll start to see rates roll over, hopefully, hopefully for the rest of today and into next week. And that would kind of support the thesis here that next week could be a really good week for equities. And the 10-year yield obviously rose, over 4 basis points in the last couple of days as well. It's moved quite a bit over the last couple of weeks, and that has put a lot of pressure on equities, specifically the technology sector as a whole. Now, we talked about next week's PCE being very important. I wanted to touch on another big point as well as to my thesis of this year being very bullish. And a lot of it had to do with this labor supply issue. I pointed to a bunch of historical data showing that technology is the only real solution to solve that problem. And that's been completely true. That's why the NASDAQ's had the type of performance it has so far this year. But the other catalyst was I thought inflation was falling faster than consensus expected, including the Federal Reserve. I think we're going to get more evidence of that next Friday. And I think we're going to get even more conclusive evidence on that when we get the CPI number in September. So that's coming. But the other catalyst that I want to talk about right now is the extreme amount of pessimism that's still in the market today. It was prevalent, coming into this year. So 2022, the S&P's down 20%, the NASDAQ's down more than 30%. Everybody was calling for a recession going into 2023. Well, here we are in August with the S&P up 14, 15%, NASDAQ's up more than 30%, and no recession's in sight. Everybody keeps pushing their recession calls out further and further.
Yeah, that goalpost moves more than anything I've ever seen.
And we've called this the most hated bull market rally in the history of all bull markets, going back to October last year when the bull market started, in my view. And here's the data that supports that. So this is coming from the Investment Company Institute.
Yeah.
And this is as of August 24th. So this is just, a day old data. So
half off day old data.
Money market fund assets are sitting at $5.57 trillion across the board. Now, the retail investor, this is your do-it-yourself investor, right. Those at home they're managing their own IRAs and taxable accounts. They increased their cash exposure by looks like a couple $2 billion in the past week. So they're sitting on over $2 trillion in cash as of yesterday.
Wow.
And the institutional investor, the quote-unquote smart money, They actually decreased their cash, but barely. They decreased it by about 10%. They're still sitting on $3.47 trillion in cash. So there's still $5.5 trillion sitting in cash. Again, here's the numbers. So assets of retail money market funds increased by $9 billion here recently. And then the institutional funds, again, decreased their cash holdings by about $10 billion. So again, they're still sitting $5.5 trillion in money markets. And this money
That's amazing.
was invested.
Yeah.
It was invested in equities or an ETF or a mutual fund or something, but it got moved into money markets. Now, obviously, money markets are paying much better interest rates than they ever have been in the last 15 years because the Fed has increased,
Rates.
interest rates.
Yeah.
So, like for my customers that have some money markets at Schwab, which is where we custody all client assets for Shepherd Wealth Management clients, it's about 4.9%, which is great to take on no risk, no market fluctuations. Now, keep in mind, you're not getting 4.9% every day on your money.
Right.
You got to leave it in there for the whole year to actually accumulate
That
all
growth.
4.9% of interest. So I get that there's some attractiveness to that, especially if you've already have a really nice exposure to equities and so forth and had a lot of gains.
Yeah.
But for this much money, I mean, this is almost the same level of cash piles as we saw in 2008. And this is not 2008. The real risk in the market is inflation falling faster than the Fed thinks it is? If it is, and the Fed keeps raising rates, then they're going to cause more things to break in the economy, right? Which is the importance of, in my view, being extremely data dependent and acknowledging the fact that you've raised rates way more than you ever have in the history of mankind in the shortest period of time that we've ever seen in history. So for them to have this sort of hawkish tone today, I think the market's kind of reading through some of this rhetoric. Mm-hmm. And I think the market's more willing to be actual data dependent, because the one thing that Powell did is he did pigeonhole himself into saying, well, we're going to see what the data says. And the data says inflation's still falling, then, why the hell are we still jacking around with rates and talking tough about it?
Yeah.
Right. So if inflation's falling faster than the Fed thinks it is, and the Fed wants to increase rates, well, that's a huge risk, right, of causing some other, recessionary event that otherwise could have been completely avoided if they didn't continue to mess with interest rates. But if inflation continues to fall and the Fed recognizes that, now we have kind of the best of both worlds, where we have above average GDP growth, right, which is what we've seen so far this year, and likely to see more of that to come here in the remaining months of this year. And inflation's falling. Like, that's ideal. Now you didn't destruct any jobs. You didn't actually cause a whole bunch of people to be unemployed, but you also got inflation right on the path that you want it to be on going into 2024.
Yeah.
Like, that would be what I think is going to happen without having to change the level of interest rates, meaning that we don't need to go up or down probably for the rest of the year. And I would anticipate, if that's correct, that you're going to see interest rate cuts sometime around the end of Q1, beginning of Q2 is my thought on that. Now, that's an even more interesting point, because you would normally anticipate, relative to what history has to say, and we're going to talk a lot about this as we get closer to the end of the year, a presidential election year. You would generally think a ton of volatility, because that's what history would have to say, specifically after Q1, Q2 and Q3 leading into the actual election day, right? So now we're in near Q4, November. That's usually where you see the nice little recovery, because now we know, who's going to be taking over office around that point in time. Markets like clarity. But if rates are coming down in a presidential election year, well, obviously, if we haven't destroyed jobs, meaning we haven't destroyed demand, and inflation has been put in check, and it's been put in check to such a degree that we don't need to keep rates high. Now we just need to decrease the Fed funds rates just because there's no real point of having them at that level. That's actually a tailwind for stocks. Like, that's usually a really good thing, for equities. So more to come about next year when we actually get there. But if the Fed plays this right, they might look like heroes in the eyes of some, not in my eyes, but in the eyes of some, if they can kind of see what the data is actually suggesting in the way that I'm reading it and the way that others are reading it as well. That the Fed really has done the work that they need to do to get inflation on the path where they want it to go to. So we'll find out all together here. But I thought it was worth pointing out that even if you thought the market was, going to be as good as it could be, Well, if there's $5.5 trillion sitting in cash that hasn't been put to work, and we only have, we're coming up on, believe it or not, only about 4 months left in the year here, that money's going to stocks.
Gosh.
And when that goes into stocks, obviously there's going to be a tremendous amount of movement in equities to the upside. So I'm looking forward to that. And the only reason that this thesis wouldn't hold is if, in fact, on the future inflation reports that we get, they're coming in higher than expectations.
Yeah.
So we'll have to wait and see.
Well, I am on bated breath waiting to see. I cannot wait.
Yeah, I mean, that's really what it's going to come down to. And obviously, I'll have a lot to say about that as we get into that. So that was everything we had for the show. We got across all the news for NVIDIA. We talked about the Fed, interest rates. We talked about some of the reasons to be optimistic about future path of inflation, as well as, if you are a bullish investor, knowing that there are still a ton of bears out there that are probably just in their own purgatory personally, that they missed out on the type of rally that we've already seen so far this year. So they're probably rooting for the market to fall a little bit, just so that maybe they can get some of that capital to work in names that have performed very well.
Oh, yeah. It's a lot of FOMO negativity. I don't want to hear it.
Yeah.
Bears need to go hibernate. Just get out of our way.
It's coming. But I really love doing this. Obviously, we'll do this again. We try to do it about every 2 weeks.
Yeah.
You can certainly send in questions directly to us, 513-630-2664. You can also go directly to our website. It takes you right to our YouTube page. We're doing this on YouTube Live. You can hop in there. If you're getting the notification bell, you'll know when we're doing this. And you can drop your own questions in there as well. I like the show. You can certainly give us some feedback on the show.
Please.
And we would certainly love to answer those questions and make any adjustments that our audience might want to see. Ez, is there anything else we got to get to before we wrap this up here?
No. I kind of don't want today to end. I'm enjoying the salad days, but where we have something else to talk about that's not inflation and it's pre-election talk. So
well,
I'm just going to
hopefully
enjoy this little liminal area we're in where.
Well, we're coming into September, which also means that we're wrapping up the Major League Baseball regular season.
Oh,
so
yeah.
we'll be hopefully talking about the Reds playoffs outlooks. But
I hope so too.
We'll have to wait and see. But yeah, since we have nothing else to give, appreciate you guys tuning in the show. We'll look forward to this again soon. Don't forget to check us out. ShepardWM.com takes you to everything about our company, our blogs, our newsletters, our podcast. Everything on Spotify is there for you. And we certainly appreciate your support and look forward to doing this again in a couple weeks. Hope you guys have a great rest of your Friday and have a great weekend.